Welcome back to XTRM Finance. Today we're diving into the fascinating, yes, fascinating world of taxes on real estate. Before you groan, hear me out. This is the stuff that can save you thousands and help you build wealth like a pro. From capital gains and depreciation recapture to 1031 exchanges and the legendary step-up in cost basis, we're breaking it all down one hilarious metaphor at a time. Stick around, because by the end of this video, you'll know how to navigate real estate taxes like a pro, keep more of your hard-earned cash, and plan for a financially epic retirement. Sound good? Then let's jump in. All right, first up, capital gains. This is the tax Uncle Sam charges when you sell an investment property for more than you paid for it. It's like he's saying, congrats on the profit, now hand over some of it. The good news, if you've owned the property for more than a year, you'll qualify for long-term capital gains rates, which are lower than your regular income tax rates. For example, if you're in the 15% bracket and you sell a property for $100,000 more than you paid, you'll owe $15,000. Painful? Yes, but manageable. But if you sell within a year, say hello to short-term capital gains tax, which is taxed at your regular income rate. Ouch. Now let's talk depreciation. Depreciation is like getting a mini tax break every year because your property theoretically loses value over time. Spoiler, it doesn't actually lose value if the market is strong. But here's the kicker. When you sell, Uncle Sam wants his depreciation deductions back. That's called depreciation recapture tax, and it's taxed at 25%. So if you've claimed $50,000 in depreciation over the years, you're looking at a $12,500 bill. Think of it as a thank you for letting me borrow this deduction fee. Here's where things get really interesting. The step up in cost basis is like a magic reset button for inherited real estate. When your heirs inherit your property, the cost basis resets to the current market value. So if you bought a property for $100,000 and it's worth $500,000 when you pass away, your heir's new basis is $500,000. If they sell it for that amount, guess what? No capital gains tax. It's like hitting the skip taxes button. This is why real estate is such a powerful tool for generational wealth. You build equity, enjoy tax advantages during your lifetime, and then pass it on tax efficiently. Rockefeller-level planning, anyone? Real estate can be your best friend in retirement, especially when it comes to long-term capital gains. Here's the strategy. Hold on to your properties for the long haul. As you sell them off gradually in retirement, you'll likely be in a lower tax bracket, reducing your capital gains tax rate. It's like getting a tax discount just for retiring. Combine this with rental income and Social Security, and you've got a diversified income stream that works smarter, not harder. Next up, the 1031 exchange. This is the holy grail of real estate tax strategies. A 1031 exchange allows you to sell one investment property and roll the profits into another without paying capital gains taxes. Think of it as monopoly, but you get to keep your hotels and avoid paying Uncle Sam each time you upgrade. The key is timing. You've got 45 days to identify a new property and 180 days to close the deal. Miss the deadline, and you're back to paying taxes. Bonus tip, keep doing 1031 exchanges until you kick the bucket. Remember that step up in cost basis? Your heirs will thank you. Homeowners, this one's for you. The 121 exclusion lets you sell your primary residence and exclude up to $250,000 in gains if you're single, or $500,000 if you're married. The catch? You must have lived in the home for at least 2 out of the last 5 years. This is perfect for downsizing in retirement or cashing out on that hot market. Combine this with a 1031 exchange for your rental properties and you've got a tax strategy worthy of a mic drop. Feeling overwhelmed? Let's break it down. 1. Plan your sales to align with your tax bracket. 2. Use 1031 exchanges to keep rolling profits forward. 3. Take advantage of the 121 exclusion for your primary residence. 4. Use depreciation strategically, but plan for recapture taxes. Remember, the goal isn't to avoid taxes entirely, that's illegal, but to minimize what you owe while maximizing your wealth. And there you have it, the ultimate guide to real estate taxes. We covered capital gains, depreciation recapture, step up in cost basis, 1031 exchanges, and the 121 exclusion. Now it's your turn one. Hit that subscribe button and ring the bell so you don't miss more tax-saving tips. 2. Drop a comment below. What's your biggest real estate tax question? 3. And share this video with someone who's ready to up their real estate game. Remember, smart real estate strategies can build wealth, secure your retirement, and create a legacy. So go forth and conquer the tax code. Until next time, stay savvy and stay awesome. Peace.